Hi friends, welcome to another stock of the week as part of my Dealmaker Diary, and we've got another one knocking the ball out of the park in so many ways. Well, ringing the bell, you might say. It's BellRing. You may or may not have heard of it. Let's look into this billion-dollar plus company. Net sales $1.83 billion. Okay, they've got some phenomenal numbers behind them, and that's what I like. Can you believe it? Through Premier Protein, it's a big business, protein-based nutrition products, and my lord, don't I consume a lot of those. Not necessarily this brand, but generally protein-based nutrition. We've all been getting way too little protein. We've been told we're eating too many carbs, and that's why we're all on the Wegovy. So the company has now got a market cap of just under $10 billion. Okay, $10 billion. Let's dive a bit deeper into some of these numbers. As you know, each week before I do that, what I like to do, because we are in that age, I like to look at how it's using AI. Well, it's using AI for consumer intelligence, okay, to decode consumer behavior and refine products, marketing strategies, and it's incredible how AI is in everything. Obviously, on the supply chain, you'd expect it to do that for efficiency, cost savings, procurement. I mean, no wonder the stock market keeps going up anyway, because AI is helping boost the bottom line. Digital engagement optimization to help with digital campaigns, influencer partnerships, e-commerce, all of those kinds of things made quicker, cheaper, more efficient. Smart retail and merchandising. I don't even understand some of this stuff. AI analytics to guide retail shelf placement. AI will tell you where the things should be compared to where the competitors are, and so on as well. Product personalization, innovation. That isn't quite a big thing, actually, product personalization. If you can get into making products, particularly health-related ones, where you think, okay, these are the specific vitamins I should have based upon my results, guess what? People are more sticky. So there's a lot of that and innovation going on there. And of course, quality assurance. Again, not something I'd thought of until I read it and thought, oh, right, that makes sense. That's clever. So what are the numbers which really excited me? Well, 7 on my proprietary value growth income rating. Okay, remember this is my rating which weighs the valuation of a company, revenue growth, earnings growth, dividend yields, all of this. Anything with a 7 out of 10 meets my minimum criteria. So tick for that. Now, this is a bit expensive. I grant you. Forecast price earnings, $28. You're paying $28 for every future dollar of profits, and it's not a tech company, even though, as I showed you, it's using a lot of AI. However, that is probably one of the highest I've ever seen. Cash return on capital invested. The amount of cash the company is throwing out based on the capital it's invested. In other words, it's not investing much capital for the amount of cash it's generating. Cash doesn't mean profits necessarily, but without cash there are no profits. So that is phenomenal. It's the Goldman Sachs measure that they use to determine companies in the top quartile which tend to outperform those outside of the top quartile by a significant margin, and that one definitely does and proves the point. Sortino above 1, rare for a company. What it means, lots of return, very little downside risk relative to that return. Volatility well below 20%. I love that. And does it generate alpha? In other words, outperformance of the markets? Oh, yes, it does. Well, looking at the price, is too much just priced in? Well, you know what? Minus 18 there. So, yes, you could argue it's going to go drop to a mean reversion, but those valuations are not particularly troubling. Okay. And if you look at this as 2022, the mean reversion looks closer to that. Now, what happens if it goes there? What happens if it goes there? What happens if it goes there? Okay, from a 61 to 22. Is that likely? Of course, anything's likely. The question you've got to ask yourself is, are you in for the shorter term? In which case, if you are, you probably want to use that as a stop loss. If you're in for the longer term, you want to use that to buy more, buy more, buy more, buy more. Okay, longer terms would keep buying on the way down. Shorter term people would get out sooner. And that's the downside of being shorter term. The upside of being shorter term is you make more money over the short term if you were right. Discount cash flow, 20% undervalued. So on the discount cash flow, numbers still look good. Thank you very much. I hope you enjoyed that. And, well, you know I was going to say it. I hope it rang your bell. Thank you.